Hello everyone, welcome to DMVII Live for April 14th, 2018. This week, we were fortunate enough to have Bill Chen, a managing partner at SC Capital LLC, present about his investment background and investment philosophy. Bill's hedge fund has impressively compounded 22% over the past 10 years. And without further ado, here's Bill's presentation.
So I'm appreciative for everybody coming here and for taking time on a Saturday with such nice weather out there.
Yeah, it's
it's opportunity cost. I appreciate it. So my name is Bill Chen. Today's agenda, I really want to talk about those two stocks, but I think anytime anybody comes up in front of you guys, you need to understand what they're coming from in terms of, are they a growth investor, a value investor, a chartist, or whatnot, or a private equity guy. So I want to give you a little sense of what I look for. I mean, who I am as a person, how I was brought up, and what kind of intrigues me as possible investments. That's meaningful to me, and I think it kind of puts whatever my investment framework to see if it kind of works for you in terms of, are you of the same mindset as me and stuff. So I know I need to get to Orbitech, but I want to kind of talk about what kind of started me up on all this. I've been investing for about 20 years. The last 10 years, I've been working a lot with my family office, with my grandfather, who since passed away, to my father. But you know, we'll talk about how we were brought up, and there's certain things that kind of generated who we are today, and kind of persevered through multiple generations. But I know around the 1997, I got out of college, graduated from the University of Maryland. I was kind of at the precipice of Netscape and the internet, and everything was blowing up and stuff like that. And of course, the .com happened, and everything fell, and all of the Asian stock markets fell and stuff like that. And that was a eye-waking moment for me. So I was like, hey, what does actually work? And that's where I did a lot of research. So there's a couple of things happening here. Number one, I read about John Bogle in Vanguard and say, hey, you know what? If I just want to take it easy, I can invest in the S&P, the market, and just get my 7 to 10%, Jeremy Siegel and stuff like that. And I could do that, okay? But are there really outliers? I was like, hey, do you know what? If I wanted to play more golf and tennis, I could just do that. But what about if I wanted to know what the outperformers are? So right now, a lot of these investment advisors and family offices, they're happy. I talk to a lot of family offices, they're happy with like 7 to 10%, which is fine. If you talk to Carlyle Group or Blackstone, their investors, they want 15%, okay? So everybody has their risk tolerance and what their expected return is. And I said, hey, you know what? All things being equal, we want more rather than less. But who are the really great people out there? And what I found is there's this article written by Warren Buffett called The Super Investors of Graham and Doddville. That's what kind of started me up in this whole concept of value investing. That article is out there. It's a small article, but it kind of talks about the coalescence of all these really great high...
So Super Investor, is that?
Super Investors of Graham and Doddville. Okay. It's on Wikipedia. You'll find it if you Google it and stuff. Only 6 pages, a couple of tables and stuff like that. But most appropriately, this table here, what you notice is there's the usual suspects. You see Warren Buffett in his early partnership. You see Charlie Munger. You see Sequoia Fund. And then Walter Sklos, which was actually part of Benjamin Graham's fund. So when you think of value investing, you think of Benjamin Graham and all the people that worked underneath him. So it's kind of like in football where you see, Bill Walsh generated all these coaches underneath him and how they dominate the coaching arena and what is success in the NFL. So if you really want to go back to value investing, intelligent investing, and all the books that he said, I mean, that's kind of boring. But what you see and what we hear about is Warren Buffett, and his partner, Charlie Munger. And actually, if you look at Rick Guerin here, who actually had the highest returns and he used some leverage, and there's a testimonial too, he blew up. He used too much leverage and he blew up. But he's actually at the Daily Journal, and these guys are still friends. He's not as vocal as Warren Buffett and Charlie Munger.
What was that journalist's name?
Rick Guerin.
Rick.
Right here. And I'll distribute these slides afterwards. But the main takeaway was I was looking to say, hey, do you know what? My grandparents were selling their restaurant and their real estate, and they're like, how do we invest in this? So we actually also had a business of going to embassies and actually restoring furniture. So we had multiple different businesses with different business cycles and different rates of return, and we're like, hey, do you know what? Is there a better way to do this? So that's where I started researching about what is out there. What can we do to actually find the highest rate of return? Okay, so everybody around here would be happy with like 7 to 10%. But what about if we can do this? And what makes these people special? Are they just random, unicorns out there, or is there something to them? Turns out they're all value investors, and this is a quick 6-page read where it's uncanny how everybody with the same thought, different portfolio, different time periods, really generate a lot of alpha. Okay, and that's what started it off. Can I get Warren Buffett's 29% or Garen's 32%? For the last 10 years, I've been averaging about 24. Okay, even through all these 2008 and stuff like that. I said, hey, if I can't, then I'm going to quit this. I might as well just give it up and just accept the S&P and go play a lot of golf. So the thought process around 27 with the family office is, hey, do you know what? Quality of life, what can we really invest in making sure that our grandchildren and children are going into great schools and really having the opportunity that they deserve? So I did the research in that. I found religion, and that's what it is. What's scary about this is the Buffett partnership back in, the olden days, they were compounding really quick because they didn't have the anchor of large assets. So even right now, I said, hey, we have a good substantial amount of assets, but it's not an anchor for a lot of people. For Warren Buffett right now at Berkshire Hathaway, I think, they still have high returns, but all the returns have been happening early on, not now, right? He just has too much of a asset base. So I just looked at it, and I just found it unusual that you see the same people over again, and when he closed it up, he recommended Sequoia. So like I mentioned last week, Sequoia blew up because they made a massive concentrated bet on this company called Valeant, right, which is pharmaceutical. So when it blew up, it wasn't pretty. Bill Ackman, it blew up for him. So all these value investors, it blew up for them, and that's where I kind of scratched the surface on, okay, if it blew up, where's my opportunity set? But this kind of started off. So my influences and how it started off was with this article, actually. We talk a lot about the people that really influence me. So, you say, hey, who do you really like and how do you act like them? Warren Buffett, Charlie Munger, we talked about. Manish Prabhupada has, influenced us in the sense that, hey, why don't you get a high rate return? Why do you accept 10? So I think once you get that mindset of why accept, less return, you kind of open up your horizons. Even Warren Buffett said, hey, do you know what? If I was managing a small money right now, I could probably compound at 50%. That's him. He's the oracle. So I just look at it as if I can get in the 20 range, I'm feeling pretty good. If I'm above 10, I'm feeling pretty good. But my thing is, let's see where I can take this. And he modeled it after the early partnerships. And that's why I kind of like to read him. He's a great author and stuff. Joel Greenblatt, he did 2 books. One is, how to be a stock market genius and stuff like that. What I like about him is he's also from Columbia and Graham Dodd oriented, but he actually does options and he thinks about, what is the optimal structure of your stock portfolio. Seth Carlin has this book called Margin of Safety. If you guys haven't read it, it is up there with Intelligent Investor and Security Analysis. It's a $700 book. It's out of print and stuff like that, but just PDF floating around. And second of all, I actually went to the Library of Congress. I said, hey, do you know what? If every hedge fund manager out there is reading this, I went to the Library of Congress. I borrowed a book because by definition you're supposed to have it. I copied it. I spent 2 hours copying every damn page of that thing. And I was like, I spent $70 copying this damn thing, and it better be eye-opening. And it actually was. It was eye-opening. Mark Howard, so these last 2 people, he runs a very secretive hedge fund called Bulk Post. Mark Howard actually also runs Oaktree, and I consider these 2 people my thought leaders. They're not talking about operational and tactical stuff and high order. I think they're thinking about second order thinking. When I think about, where the market is and what should I be thinking about and do I have more risk or less risk and stuff like that. I look forward to reading these guys, people. He doesn't come out too much, but, all these people are value investors. All these people have books written about them or written books themselves. All these people are highly successful. I think most of them are billionaires. Maybe Monish and Joel is not, but they're in the top 1%. Let's just call it a spade a spade. So those are my investment influences. So when you say, hey, do you know, who do you follow? These people I do follow, and I am inspired by them. But most importantly, outside of the people that I follow and people that I idolize or whatnot, I really owe a huge debt to my grandparents and my parents. So it actually frames exactly what I'm looking for in my investments. Number one, you know, my grandparents have both, all four of them have passed away on my dad's side and my mom's side. But while I had them here and stuff like that, they instilled in me a lot of values that wasn't about value investing per se, but it was about something that transcends value investing and what I'm looking for in character and judgment. So what I want to say is, you know, my grandmother on my dad's side had 10 children, and when she was born, literally China had an emperor, okay? So she lived through an emperor. He lost his emperorcy. We had World War I, World War II, Chairman Mao, which is literally a game changer. I mean, communism where you own nothing. So both my sides of the family, we came from a very well-off background. But do you know what? When communism comes in, it's a big fat game changer. You actually go to a big fat zero, okay? How do we rebuild from that? And that's the story that my grandparents told me. What are the things that we really care about, and how do we regenerate where we were, okay? And that's what it is. So when I look at stocks and stuff, I look for not where are we today in a bull market or bear market and stuff like that. From an operational perspective, I look at it as how does my grandparents and my parents survive in good markets and bad markets? How do businesses kind of survive through different market cycles where you get bad beats and good beats, and how do you kind of, you know, inch on up and stuff like that. So what this kind of shows you is, you know, my grandparents, you know, they passed away about 10, 15 years ago, major influence in my life. They lived through the different world wars, and they had kids that they had to separate, and they were really well off. They had maids, and they had a bunch of assets that they left behind. So I'll talk about what that translates into, but they came to America in 1960. A lot of stuff was happening in the 60s. You know, a lot of stuff that I've never had to witness, but it was not China. I'll just say that. In a good way, it was better than China, but in other ways, it was just different. They were a foreigner in foreign land. And you know, they opened up a Chinese restaurant, and that became the foundation of, you know, how all my uncles went to college and how they all went to prominent jobs dedicated to education. But how do you live through a massive recession in the 80s? How do you live through the oil embargo and stuff like that? Those stories kind of resonate with me. You know, so you got to have some stress in your life, and how that translates to from the tenements from my elders is culture and people really matter. And because people actually run companies, everything comes from up top. So when we were in China, we had to get a lot of help coming here to America and stuff like that. We abandoned everything to come here. Where there's stress, there is opportunity. Okay, whether you are in it or whether you're a bystander outside of it, where do we find opportunities to buy businesses at 50% off and stuff like that? That's what we were thinking about in the last generation, where, you know, first you don't have a lot of capital, all you have is trust and people that have helped you out along the way, and character does matter. Number two is when we were running a Chinese restaurant and also running these apartments in China and stuff like that, we can't control whether the communists will take it or not, or we can't control whether it's a boom or bear market or it's a good leasing office. There's macro things that we couldn't control, but we have to kind of plow through it. What we could control was cost. Okay, that's the one thing that every company, every person can control in their lives and stuff like that. So they bled into us almost like Sam Walton, cost control and everyday low prices, and can we be the low cost provider and really eke it out? Because when the recession does happen, you got to survive it to get on the other side. So I think that's something that they always instilled in me about operational excellence. Liquidity, when you're trying to get out of China with whatever you could have because it was going to get confiscated, certain things are better than others. You know, I mean, gold is king or cash is king or whatever, but They didn't have Bitcoin back then, so you can kind of translate it and stuff. But liquidity is valuable, okay? Sometimes where there is lack of liquidity, there's opportunity, and that's where we come in and can provide that, because we do have that, right? So that's something that they've always talked about. And think long term, because they weren't just thinking about themselves, they were thinking about their children and their grandchildren. Even right now, I'm thinking about my children. So multiple generations. How do we, perpetuate this and make sure that, this family office is built to maintain the beliefs that we want. So we don't want to be like the Vanderbilts and kind of blow up. There's plenty of stories about that. So we actually think about that. We're going to probably be in a couple bad beats in the future and stuff like that, but we survive, Lastly, they taught me immensely about accountability. You own your actions and your inactions. So I look at it as, when I look at a company, you got to own up to your bad mistakes. Otherwise, if you don't acknowledge it, you're just going to repeat it, okay? So for us, we understand what we can't control, and we take credit for that. Probably not as much credit as we should. But we want to be very cautious with our capital, with our clients and stuff like that. And ultimately, you got to be accountable for whatever you do or you don't do. How does it translate into an investment framework? So I know it came from my parents and the operating environment and stuff like that. So there's a lot of stuff out there. There's a lot of opportunities and a lot of stock that comes at us. Some of which we actively go towards, and some of which gets kind of dropped in our laps. And how do we filter all this information and stuff like that? So, like I said, opportunity and stress creates opportunities. So we look for unfavorable industries. So when I was talking earlier today, we look at the 52-week low. We just look at that because that's where, the baby gets thrown out with the bathwater. Okay, we look at that because, we look at properties out there, just as a segue, we look at properties, but just because it's a great property, the person on the other end might not want to sell it, not on the terms that you want, not with whatever you're trying to offer. They want something tiered for tax reasons and stuff like that. There's just so much, but in the market, as there is a fluid market, there is an opportunity where you can have that transaction, you can get into a position, you can scale and size a lot better than a lot of other avenues out there. So what we look about is in our pool, we're not Warren Buffett large, but we want to make strategic investments and we want to be able to get so we look for unusual places, things that have gone wrong. We want to kind of scratch it and say, hey, can we add value as owner-operators? Can we add value as people that can just inject capital in there? Or, hey, they don't need capital, they just need time. Can we be part of that investor base to just give them that time, okay? We went through a lot of businesses. I mean, we have, apartments in China, and we do have opportunities here in America and real estate. I just look at it as, if you look across the board, it's really hard to get a net profit margin above 10%. A lot of companies can't barely eke out 5%, and if you're lucky, you get 7%. If you own a McDonald's franchise, you get 10%. If you own some of these Michelin star restaurants, you get 10%. You're working your ass off. We worked our ass off, waking up at 5 o'clock in the morning, and then cleaning up at 11, go to sleep, wake up again, and we do it again. There's better ways to make money. But we did it, we didn't have Christmas off, you see those stories. It was a tough living. It was up and down, and it was just grinding throughout the year and stuff like that. We didn't have two months off during summer to just take a summer vacation. My parents and my grandparents actually did close a restaurant, the sole Chinese restaurant in Chevy Chase. So they were in the right place at the right time, and we owned a monopoly, but then it got commoditized. So I kind of lived through having a decent Chinese restaurant with a monopoly in a very affluent area. Back then, Chevy Chase was the suburbs, really distant, like what they think about Germantown. Right now, it's in the heart of where the action's at, but we just saw how it kind of morphed and how the market changed. So what we did is, it's really hard to get more than 10%. If you see 10%, we're intrigued by that, okay? Without leverage. You can leverage up all you want, but when we look at it is, if we can get above 10%, we're interested. And Orbitech was that, actually. Current assets, I talked last week about debt. I mean, when the market frees up, whether it's 2008 or whatever, the Asian bubble or something, when it freezes up, nobody wants to call you, nobody wants to return your capital, nobody wants to do anything. And during that time, we've seen it multiple times. When you're trying to get out of China, when you're going through the oil embargo, things lock up, okay? And banks don't lend. I mean, they're not gonna just lend for the sake of lending. They're gonna have overly restrictive terms. It becomes a loan shark opportunity and stuff like that. So that's what we realized, you never know when that happens. And sometimes you don't expect it to happen, but when it does, you're tapped out. You can't refinance, you can't liquidate your assets and stuff like that. So we like businesses that have a lot of current assets, hopefully the current assets over debt, okay? All this funny stuff, I mean, we do value brands like Coca-Cola, and we do value brands like, all the Heinz stuff. We do understand the value of brand, but we don't want that being more of your assets than anything. If it balloons up, it's not liquid. It's hard to sell an asset when you're like, hey, I'm trying to sell Coca-Cola. There's only limited buyers out there, and you're not going to get that pricing power. There is a hierarchy of cash. Cash is king. It's the most liquid. Whether you do CDs or bonds or whatever, as you go further down with accounts receivable, we sell our receivables, when I work with government contracting companies and sell our receivables, just because the government takes 60 days to pay you at times, they need to sell that receivable for 80 cents on the dollar. That's 20%. That's a great business to be in if you're Wells Fargo and stuff like that. So we see selling receivables, and we know that you need to sell your receivables. There's certain private equity funds that just circle around, or vultures looking for that. Colony. If you want to know who they are, look at Lehman Brothers, okay? When you know who the distressed buyers are, look at the articles on who helped Lehman Brothers and Bear Stearns, and they're the vultures. And they make really good money doing that, okay? It's like all these people doing bankruptcy liquidations and stuff like that. They're not businesses that you see that often, but they're very lucrative when it does happen. So we just say cash is king, all things being equal. PE of about 10 or better. I know a lot of you guys are espousing, hey, do you know what? I got this PE of 20 and stuff. You got to understand what an earnings yield is, which is essentially a reciprocal of that, right? So PE is not the end-all be-all, but when I look at it is, if you have all these earnings that come to the bottom line, what can you do with it? And we talked last week about we could reinvest in the business, i.e. buy more businesses, some of which might not come into fruition. You're kind of gambling. Number two, you could pay down your debt. Number three, you could pay it to your shareholders. So those are the three main things that you can actually do it. Howard Marks said that. So we look at it as, if you don't have ideas that can generate 10%, kind of bring it back to us. And that's what Warren Buffett's been doing. He says, hey, you know what? If you have excess capital, give it to me so I can be fairly distributing and lending now. That's why he loves businesses that are capital intensive right now, because he has really cheap capital flowing from different places. Definitely Geico and all the insurance businesses. And he can allocate it to businesses that he can have a competitive advantage, i.e. the utilities and all that, where he's like, you need capital? I got capital as close to the Fed funds rate as I can and stuff like that. That's genius, and that's something that only Warren Buffett can do. That's not where we live, but I just look at it as the lower the PE, the higher return. If you can find me a stock that has all cash with a PE of 1, just call me. At midnight, at 1 o'clock, just call me. Okay. Lower is rather better. We want financial discipline. I mean, we had things, we've seen people over leverage and stuff like that. Debt is a big fat killer. Debt is something that if you put a dagger right in front of your steering wheel and you're driving around 99% of the time, it won't happen, but when it does, it's devastating. Okay, so we like operators that are like, hey, do you know what? It's good. Why do we need to eke out another percentage to take all this risk and stuff like that? We do like people just paying it down. That's just how we're kind of born and bred. And you'll see that in the two stocks that I'm looking at. In leadership and realistic expectations and targets and stuff like that, we know if you're looking at this, you're big time headline risk. People don't love you. Nobody's selling you anything because you're in a bad situation. You know, people want to fire you as a CEO. People want to sell your stock. Nobody's selling you any bonds right now because if you're on the S list over there, everybody's downgrading you because they're not selling you any services. They're not making any fees off of you. And you're like the only person in the room and stuff like that. You know, you're looking for friends. So we know those CEOs have to make a really tough decision. You know, firing people, divesting and stuff like that. those awkward moments, that's where character matters and stuff like that. That's where we feel you're going to have to make that tough decision. Like when I go into businesses, and help them kind of streamline it. You know, when I come in, I'm saying, hey, do you know what? Wherever you are, you're not in the right place. And I know you need to make a tough decision. Sometimes you need a consultant to come in to give you that decision and stuff like that. I'll look at your financial reports. I look at where you're making your money and where you're not making your money. And I'll look at the things that are totally unprofitable. I said, that's what it is. You're not going to pay me anyway. But that's the truth, right? And that's not a good time. I've been around that. I've seen it on different ends. I've seen it in the stock market. I've been witnessing a lot of these government contractors that do that thing. It's not pretty when their market and their business is dwindling and they need to make tough choices. But do you know what? If you can strip away the fat, the cars, the lifestyle brands, the tickets to the Redskins, clubhouse and stuff, strip that all away and let's get to like brass tacks and get to, a really streamlined businesses. That's what private equity is doing. They're just giving you not what you want to hear, but what you need to hear. And we like that. And when you need to hear, you got to deliver that message. So we like to see people kind of dig in and say, hey, this is not going to be pretty. I'm not going to get invited to Christmas party, but if I really want to make an impact for this company and stuff like that, I got to say this. And we look at that. And we look at what we would do in that situation. So those are things that my grandparents did, because you know what? My grandparents had to leave my parents back there. You just couldn't take a whole family. So my mom got left back in China with my dad. They were teachers during the Cultural Revolution. You don't want to be a teacher when it's anti-education and you're like, what the hell's going on? I'm like the most educated person here and I'm digging a ditch, So markets and society can get kind of crazy out there. And that's what I learned. It doesn't make sense, but sometimes you need to grit it out. You got to survive to this so you can get to America and build a new lifestyle. So that's kind of been bred in. If all those things happen, good things generally happen. In what ways? Number one, if the insiders are like, this is crazy. I mean, I could just buy it out and just keep all the money myself because I'm getting a high rate of return. I'm getting 50%. I might as well just take it and make it my family office. Or private equity would come in. If you don't have any debt and you have a bunch of cash, if I had like a chest of gold coins here and every day it gets refreshed with more gold coins and stuff like that, somebody's going to look at that and be like, I think I'm going to pay like $10 for, $50 worth of coins in there. And it kind of compounds. It's like the golden goose. So what we noticed is Orbitech got bought out. There's another company that I can also give you that we just recently bought. If you have no debt, high rates of return, somehow people come out of the woodwork and they want to buy you, whether it's private equity because they're looking for investments and they got cheap access to capital, so they get off the spread. Number two, you get a competitor buyout, which is what Orbitech turns out. We're going to get to that. But they get bought out, and as an investor, if you bought it low, that's your buyout. That's your exit strategy. Although you want to keep it, those insiders want to kind of just, monetize. Lastly, investors like me, value investors will come in and just buy it. We want that consistent base that, we can go to shareholder meetings and actually advocate and say, you're doing the right thing. You don't need to be on Forbes, just do the right thing. Multi-generation, just do it. Let's get us out of here and let's make some cash. Lastly, activist investor. If you're a complete idiot, we're going to come up and try to get enough shares where we can vote you off. That's really expensive. I try not to do that. I've talked to other investors who have done that. It's a massive coin flip. It's a massive, massive coin flip because what people can do that own it, if they're corrupt and not trustworthy and stuff like that, they could just spend the money before you can get your guy in that perch and stuff like that. So it's a risky proposition and stuff like that. I know there's a lot of people who've been successful in that, and sometimes if you find the right activist investor, you can go far with it. But all these people are pro-investor, pro-shareholder, pro-alpha. And that's what we're looking for. We're just trying to get the highest level of return. So what we look for is we can get that cheap rate of return and compound at 15, 20%, and there's a premium for that higher rate of return. I'm getting in the 20, 24% range over 10 years, and that's where we want to be, right? Okay, so the things that we look for, if a lot of you guys are in business school, there's this S-curve that talks about product maturity and business maturity where you're a startup, and then you're a startup and you're doing well, and as you do well, your business grows and stuff like that, and then you become like Coca-Cola where your market gets saturated, and what do you do there? And there's an inflection point where, oh my God, I've grown too big, Am I going to decline as a business, and do I go out of business, or do I, revive myself by adding technology, reinvigorating, kind of, tear myself apart? Examples over here: GE, okay, a lot of the banks, AIG, all those people that were mature businesses. So I put this up in two things. In this range, high PEs. That criteria of less than 10% PE is not going to happen. Down here, you're a unicorn. Whatever $2 of earnings you're going to do, and you're priced at whatever, at 100, you're going to get the Netscapes out there. You're going to get the Ubers out there and stuff like that. We are not successful venture investors. We don't play that, okay? Where we see most of our opportunities in our set is we like these companies that might turn into value traps, but this is where GE is at. This is where Deutsche Bank's at. This is where Bank of America was at. This is where Citigroup was at. Super liquid, super easy to get out. There's a bunch of data out there for them. We kind of understand it. There's a lot of research, and this is like moving a big aircraft carrier. So you do get those price points where you're like, I don't believe why Kraft right now, or Coors, or Anheuser-Busch, or GE, or all these companies, why are they so cheap? L Brands, you name it. There's a bunch of stuff kind of bubbling up here. Okay, you're like, it doesn't make sense. Are they dead? Well, maybe it's Macy's or Nordstrom's or whatever, JC Penney. We don't know. But this is where we add competitive advantage. We want to understand the industry. We understand who is going to be surviving because of their operational excellence, about strategic plan, and stuff like that. Over here is like last week's stock, which I gave you, like TARO. Over here is kind of like Orbitech. It's also about this other company that escapes me right now, Ruger as a gun company. They're kind of tweeners. Okay. Over here, you can say even Apple was this, but Apple, Microsoft was over here. And depending on what price point you buy them, it was a good investment. You can get that 10-15% that you want. Over here, you get these tweeners that like, you're not a startup, you're not sexy anymore. And this is the Marshall syndrome, right? So you're kind of in the middle, you're the middle child, and you don't know what you are. You're not big enough that people have a lot of coverage. Nobody wants to kind of lend to you. You can't grow because of family money, and you can't grow from banks. You're just kind of like in this awkward stage. And the only way is you got to grow out of it, right? And if you're rating high rates of return, you can't get debt here. You cannot get debt here. And that's why if the business model is legit and you have a great idea and you can compound, you got to self-finance it, right? So over here you can get debt because you're sexy. You're kind of like dreaming about how big Uber can get and stuff like that. Over here you're kind of like, you're yesterday's news. So we find our best opportunities in the mids, which are in the 2 billion to about 10 billion market, and they can double. 10 to 20 is not astronomically where it blows people out and stuff like that. This is me to work, okay? Over here, you're just doing, they're big, but hey, do you know what? If you're buying Bank of America at a 40 billion market cap and it goes to 80, and right now it's at like 140 or something, you got your double there. It's built in, right? So we're getting our doubles here and here. And that's what allows us to do our thing. Right here, where you're the Facebooks out there, and you're the LinkedIn, and you're all these sexy stuff, Tesla, Amazon, it's all in there. You're kind of headline worthy. We never find those opportunities. We will miss out on Tesla. We will miss out on Amazon and stuff like that. Yes?
I don't understand all this, but you said right there is a GE, right?
Right here.
So what do you do with GE? You buy or you buy?
It's too early right now. So I mentioned last week, right now they're doing the right things. They're divesting their crappy businesses. Whatever cash you can get, just liquidate it. 50 cents on a dollar. If they don't make logical sense, they don't earn their capital rate, you got to give it back to me. And what do you do with it? I personally think the one thing that you don't want to do, but you should do, is kill the dividend. If you're hemorrhaging cash and you're trying to figure it out, keep all the cash. Don't distribute it out. Just keep it all in. Figure it out. Don't distribute it. It might kill your shareholder base of people that want dividends, but you're getting a 1% dividend and stuff like that. That's meaningless. I mean, it's a headline risk. I hate when they're like, okay, we're going to try to maintain our dividend as much as we can. I just look at it as fix it and then have a massive special dividend later on. So what I said about GE, right now, GE, Macy's, you can even say Deutsche Bank, which we're going to talk about, is in this phase. Like, you don't know if it's going to be a zero. I don't know. If it's an economically viable business, you don't know. It could be Amazoned out, right? With GE, it might be so big that what is it? How much risk does it have? The complexity in your books is really confusing to everybody. It's a big fat black box. So a lot of things that we want to do is simplify it so somebody like me can understand it. I know where your stream of business is, and I know these X factors. GE, with its financial stuff, we don't know what the hell it has in there. It has this huge aerospace kind of turbine business. It's good, but it's very capital intensive. Do you even have capital? Because all that capital is being sucked into this black box that we don't even know who's your counterparty risk, right? So right now, simplify the business. That's what we advocated. AIG was in that similar front. AIG, Robert Beauchemin, I believe his name is, he passed away. He was a great CEO. He passed away from cancer. It is very tragic because he was actually one of the people that I said, hey, 20 years from now, I would love to be him in terms of who he is as a person and stuff like that, and all the people that he surrounded himself with. But I look at it as what are the tough decisions I can do. So how this relates to Bank of America, Citigroup, AIG, and all those, when the market collapses and when the government gets involved, they don't want any headline risk. Politics is about headline risk. They don't hire the marketing flashy guys. They hire brass tacks, like structural people that just rolls up their sleeve. And Robert Moshev was called back in from his prior CEO job. He was retired. He got a call and said, hey, do you know what? I really need your help here. Brian Moynihan was not a great speaker, but he was the right guy for the job. That's the time of when introverts win. When you want the job done, I don't want all the glitz, the marketing and stuff like that. You got to get that guy that just works. That's just a hard worker and stuff like that. So that's what we like about disruption. People look deep down and says, I don't want you to sell me the dream. I need you to fix this and keep this alive. I'm not telling you about, hey, do you know what about these private islands and stuff like that. So in GE, I think that is the right guy. The prior CEO, I never invested in GE because I didn't know what he is. I saw him on Charlie Rhodes and all these things. I mean, he's a great Jack Welch 2.0. But what they need right now is streamline the business, sell away all the crap, figure out how much that core business can actually do. And then once you have a solid foundation, build off of that. Too early to tell right now.
What is their core business?
You tell me.
I've got aircraft engines.
Okay, how big of a percentage is that?
All aircraft? I don't know.
You need to know, man. Before you invest, you need to know. I would just say there's too much risk because at any given time, if the market locks up, it is screwed. What I will know is in probably 3 more quarters, we're going to see. So I'll get to you in 1 second. Every time I turn my back, you're like, I got to restate these earnings. I got to, mark down my earnings report. I'm like, come on, you obviously are not lying to me, but every time you unturn a stone, something bad happens, right? And I said, until you understand what you actually got, you're going to get these crazy ass surprises. And when you surprise the market, they just crush you, right? Maybe overly crush you. I just look at it as, I don't know what is the steady state of the earnings right now. I get a lot of GE saying, hey, it's so cheap, it's down like 54%. I was like, okay, what is this fair market value? It's not below book value. It's not below cash on hand. If they can give me, we are going to officially earn $1.40, I would put a 10% multiple on that and say, okay, steady state, I'm just going to get that for the 10 years, $1.40, and I'm going to price it at $14. I'm just going to cross my fingers. If I can do better than that, I can do better than that. I mean, so there is a new book by Annie Dukes. It's kind of interesting. She talks about resulting. We don't need to get into that. But, so I would say I have more confidence over Deutsche Bank, which we'll be talking about next, than GE right now. I'm looking at GE. And once I know what it's worth and what is my price that allows me to get my, 20%, I'm in. I'm in with options if I really want to, right? Yeah, I'm doing puts and all the operational stuff that, I can think about. And what is my fulcrum security? I would think about that. But right now, it's too unknown. When it was at 21, it was interesting. Now it's down to 14.
Yeah,
it's still
so let me apply, the same thing that I'm talking about GE.
Yeah.
Okay, and GE did make some bad kind of investments. Baker Hughes, for example, they did get rid of its financials. But the oil is coming back. I mean, it's a little bit high. And I think Baker, so they had bad years because oil was very low. Now with oil above 60, they might do well. And $14 basically, or $13 is a good price. So I don't think that, that
I don't think it's the
your
worst thing that you
arguments
can
for
do.
it basically for me,
Yeah.
I'm not quite kind of, convinced.
I just look at it as that's not my number one stop.
Yeah.
But do you know what? I see it all the time, and I look at the guy. I'm like, he has a tough job. He really has a tough job because he got handed a really bad hand. Question.
Oh, I was just going to say about aircraft engines. It is a good business to be in, and therefore there are some real heavyweights in it besides GE. They are up against Pratt and Whitney and Rolls-Royce. Those are two powerful competitors.
Absolutely. There's an interesting thing because AIG had a leasing arm for their aircraft business too, and I know Rolls-Royce, they're based out of Britain, but they also have a huge presence over in Reston and stuff like that. I mean, Rolls-Royce was a stock that actually I think Sequoia was into or something. So it has interesting dynamics, and once you make that investment in this aircraft, there's long revenue streams coming out of that from servicing. So it's interesting. I just say GE is interesting. I don't think it's going to die. I don't see if Warren Buffett invested in it through like a preferred, that would give me an indicator. I haven't gotten all the indicators that would make me sleep well at night, right?
Is it still in the Dow?
I believe so, but I'm not sure. It's getting that range that it's.
If it drops out of the Dow,
that's gonna hurt.
won't,
Yeah.
won't a lot of.
Do you know what? It's headline risk. If it drops out of Dow and goes down another like 50%, I'll be interested. It's all about price and stuff like that. But I'm not in it right now, but I am observing it. I emphasize with the guy, and I'm like, hey, it's a tough job. It's a tough job. But it's there. Depending on how he can like right size it, and what we look for is we're not looking for the size of the company. We're looking at the most profitable company. So we have a certain appreciation for small companies with high rates of return. I'd rather you be small and excellent than big and unwieldy and stuff like that. So that's our universe. We look at the S curve, and where we get the most value is in those 2 points. We look for L graphs. I think we talked about this. We like to see the cliff. This cliff will show us the 52-week low. And what we realize is we don't see a lot of V's where it's a dead cat bounce, where it comes down and it shoots back up again, right? I mean, those are like flash crashes and stuff like that. We look at, this is Terra, which I introduced last week, and I talked about the balance sheet, and we can go into that a little bit. We talked about, hey, what happened here? When it gets stressed out, the good news is, do you know what? Even when it crashed down here, the PE was still relatively low. We don't, what we see and what we'll see in the next slide is it goes down and you have no PE, meaning you have no earnings. What happened there? Is it a one-time, one-off? Or is it a structurally flawed business? We care about profitable businesses that generate good rates of return. So we look at stuff that falls down. That's our research. We don't get like brokers or analysts calling us per se. We just look for that cliff, 52-week low. Mainly New York Stock Exchange. If you look at NASDAQ, you get a bunch of pharmaceutical stuff. I mean, if you see pharmaceuticals, there's like 90% of this stuff that just falls in there. We don't venture over there too much, but once in a blue moon we get a tarot, something like that, and stuff like that. But we look for L graphs. I don't think it's patented or trademarked or anything, but we looked at that. We like that, and then do you know what? While the market's figuring out is if it's a viable business, it's what you guys talk about consolidating. What chartists talk about consolidating, building that base, reshuffling their shareholders. People that want dividends up here, once you cut the dividends, they're out, and they got replaced by people like me who are activist investors or value investors. Over here, we're accumulating. We're getting the BlackRocks in there. People that don't want it and just say, I'm tired of this. You're getting a different shareholder base. Hopefully a more patient shareholder base, but we can only be patient for so long and stuff like that. But this is what this L shape means to us, that do you know what? Whatever the view from the market is, it's different, and we want to kind of evaluate that. So we evaluate here. I don't need to do the research for months because it's going to take me time to look over prior earning reports and how they talk about it and took at conference calls. But when we do, we're in big. Okay, so we're in Taro big actually. We like you. If we do this right, this is Club, which is an activist thing. Actually, this was an activist play. We were in it. The activists started buying at 7. It went all the way down to 1. We were in it around 4. Actually, it broke out of its resistance at 7, and it's been going up to 8, 9. It's an interesting play, activist play. Think of a young Warren Buffett. We like this guy. I mean, we get people that are good owner-operators, so he comes in, he streamlines everything. They own Washington Sport Club and the New York, Boston Sport Club. What he did, sold a bunch of unprofitable real estate, paid down his debt, It bought back its long-term debt at 40 cents on the dollar. So right off the bat, you had the debt, somebody paid 100% for that, and you buy it back for 50 cents on the dollar. That's accretive and stuff like that. So those are good operational moves and stuff like that. So we're looking for the U. So it comes down here, and we're like, oh my God, what's happening here? This is not as liquid as we want it. And if you notice from right here, it didn't get a lot of earnings and stuff like that. So even stuff like this is a microcap earlier. We will accept bad earnings because when you need to write off stuff because somebody was kingdom building, you're going to get negative earnings and one-offs and stuff like that. But if you're a good owner-operator or a good activist, Sadar would be in this case. We like to partner with those people. Okay, so this guy is actually Patrick Falk, and he's based out of New York, and he's not as famous as Warren Buffett, but he came from Oak Tree Capital, which is where Howard Marks came from, and he's doing some interesting stuff from an activist investor point of view. So we like to see where he is. He actually converted BJ Holdings and a bunch of other plays. So generally, if you kind of ride an activist, or kind of like parasites, you can make some good alpha off of that. Yes?
I'm sorry, I keep asking a question. You said when it dropped and then it went up that way, you bought it, right?
I look at it as, it dropped here. We weren't at 7, but there was a couple articles, and we saw what he was doing to the balance sheet. That in this area, we were evaluating who he is as a person. What was he doing? Is he doing what we would do?
Was that the bottom? Was that the bottom right there?
By definition, from the chart, it's the bottom, right?
So that's when you bought it, right?
No, I bought it right here. So you don't need to catch the very bottom. Like I
I'm
don't
trying
catch
to
the very
find out
bottom. I'm
when
not
to
that
buy.
lucky, right? I buy 50 cents on the dollar, 40 cents on the dollar, and it just averages out. As long as I'm not buying 90, 95, I have margin in. Margin of safety. That's the name of the game, right? I'm getting that. So, do you know what? I didn't feel comfortable. Like GE might be here, might be here. I don't know, but I got comfortable here. Okay? And we sold around here. Maybe we should have kept it. I had bigger ideas that I felt were double. I got my double in 2 years. So if we're doing our job right, it's a big fat U. It goes and it comes back up. Yes.
You don't buy a stock that's in a steep downtrend.
I try not to buy a dagger, like a falling dagger. I guess that's what they say. I just look at it as.
Well, I don't either. I just wanted to.
Yeah, I mean.
Everybody to hear it.
Everyone's got their own point of view.
Do you know what? There's dead cat bounces where you buy it and then it goes up here. I start believing in a dream right here. I'm like, this is gonna go up to the sky. So I know my temperament. I know what I'm looking for. I look at it as this is nice because it collapsed all the market information into a visual medium. But I'm really looking at the balance sheet, and we're going to get to that soon. I apologize for this taking longer. How much time do we have here?
Until 1, that's it.
Okay,
That's all I
sorry.
do.
Okay.
Do you still have
a half hour.
Okay.
Do you still have confidence in Taro, like having possibilities? I know because you're out of it right now.
No, I'm in Taro.
You are wonderful.
Yeah.
I'm not there.
Yeah, so I mean, we have to get the Orbitech pretty soon.
Oh yeah, here you go. Okay. Orbitech. There's a couple things. I'm not sure when your guy talked about it.
Orbitech.
Yeah. So here's my thing. I'll be forthright. I'm not a semiconductor guy. It does all these electronics and stuff like that. But I look at it as how would I screen this company really early on? What are the things I'm looking for? And it goes back to what the tenets I had about investment. Yes. Question?
Yeah, I'm just saying, I said, the fellow was here, this Josh Humey, he just did a really deep dive in all his filings. I mean, personally, he was sort of over the top, if you will. But He knew the stuff.
Nothing
Like, oh,
over
wow.
The more you know, the better.
Yeah, and here's what I'm doing. I mean, do you know what? I'm relatively lazy. Give me a week on this, and this is what you're gonna get, right? Number one is there's a buyout at like $69. It's trading at like 62 or something.
Mm-hmm.
I'm like, hey, do you know what? Like Warren Buffett says, you know, you give me a stock, you give me about 10 minutes, I can tell you if I'm interested or not. That's what I did, okay? Because there's just so much information that you got to filter through this whole universe of stocks, find out the 10 or 20 possible prospects, and start drilling down. You don't have time to research 5,000 stocks. You know, knowledge is accretive, so Warren Buffett knows a lot about different industries, but I only have core competence in certain industries that I like reading about, that I've read about, and I gotta drill down. For this and stuff like that, there's various reasons why I wouldn't invest in this, and there's certain reasons I would. This would be in the, I don't know, but I would research it. I wouldn't deny that he didn't do a lot of research. I just need to understand myself. But this is my, I would say, 2-hour analysis of this. I said, okay, let's go to Yahoo Finance and look at it. Okay, number one, I talked about stress. Boom, right here. It was not making any earnings here in 2014. What happened there? And then since then, it's gone up. You know, it's not at 10, but somehow it was definitely not profitable, and suddenly it shot into profitability, right? If you get 1 cent of profitability, you might have a P of 100, right? Does it go from 100 P and start trending down back to its normal steady state of 20? I don't know. But what I look at is, this is not the L that I was looking for, okay? But if I was looking here, if I took this down to here, there was an L here, actually. There was an L, so it's all perspective. But if you give me a stock, I'll look at the chart. I look at, you know, is it making money? I need it to make money, because if it's not making a lot of money, I'm not even interested, right? So right now it does make money. And what I want to do here is, when I have a stock that you guys present to me, I want to look at the financials, because we can look at conference calls, but I want to boil it down to the numbers, because it's all about the numbers, right? So we're going to do qualitative with Deutsche Bank, and we're going to do like numbers with Fortech. So a couple things. I look at the income statement. I said, how much money do you make? The things that I'm interested in is, this is your revenue. Your revenues are going up 15, 16, and 17, okay? So I want to see the gross profit. Everybody in America seems to have 50% gross profit margins. That's just the name of the game, actually. You know, that's not bad. You know, some of them have fewer gross market, but I just look at it as, this is how much it costs you to build a product. Two things that can happen. If you have a CEO that really wants to just suck this business dry, meaning take all the wealth and really put it in his or her pocket, the SG&A is where it's going to come out. And that's where I want to look at this number as a percentage of that, okay? Because once they take your cut, how much is left for you guys? Because this number down here is what you guys take to the bank. That's your earnings, right? That's your earnings yield. So the more percentage that this can go up, and this goes down to 8%, 5%, you know, they're kind of stealing away from you guys, right? I want, how much does this drop to the bottom line? So I always look at the sales and general administration. How much of the business, running the business, is dependent on sales? You know, does the percentage of this go up to this? Number two is, when you have a locked up market where the revenue goes down, you can't fire people that quick, right? You're going to be burdened. You're going to have to just pay out of your pocket to keep them there, because if you lose your staff, you don't have anybody selling. I mean, you can streamline and stuff like that, but generally, that's not a good morale, and it's like the death spiral, right? So I look at it as, this number is, how high can it be? If this number is not 10% in general, I'm not kind of interested, right? So what I'm looking for is, how much of the CEO and his posse is taking out of this? And what about if they got to run lean and mean? How can this survive? Would they have to cut on R&D? So that is the continuing operation, just running the business. The number two, why I hate debt, is, you know what? When it's locked up, when you need money to kind of fund these capital expansions, this could get really big. When you need to reset the interest rate, it could get really big, and all this can get sucked away, and this could go down to zero. And that's why I don't like debt, this interest income and stuff like that. You never know when that goes against you, because your sales dry up, and then you got to keep the CEO happy, and then the bank comes in and says, I want my money. You either need to sell it, but you gotta return it to me. And that's where things go bad. And generally, if they don't have a lot of debt, I don't need to deal with banks and third parties. If the CEO is incentivized by being an insider and they have a lot of stock options, they don't want to pillage it because they make a lot more money here. What happens here is, let's say you're running a restaurant, my grandmother's restaurant. Here, we make $56,000 a year. Let's just say that as a private business, $56,000 goes into my checking account. If I suddenly put that on the market, I get a 10% multiple on it, right? I get 10 times my money. You know, whatever was $56,000, I put a 10 multiple on it times 10, it suddenly becomes $500,000, right? So there's some leverage there if I just go public with it. And that's where I said, hey, I'd rather the CEO be incentivized by not putting cash $1 for $1 in his pocket, but actually being aligned to me as a shareholder getting a 8, 10, 20% multiple on that. That's what I look at, right? So sight unseen with Orbitex, it was 8, I think it was like 7, and it was just getting better, okay? It was getting from, somehow, as your sales grew, you got operating leverage, which went straight to the bottom line from 8% to 12% within 2 years. It's going in the right direction, okay? You're getting more sales, you're not, without leveraging up with debt, right? None of this financial kind of double it up by using leverage and stuff like that. Number 2, I went into the balance sheet, okay? So this is the balance sheet again. What I was looking at, this is your current assets, current asset as a relative to total asset. It has most of its money in its current asset. None of this funny kind of goodwill intellectual property stuff. It's good, but I want hardcore cash, which we talked about. I want hardcore cash that if I need to run to Canada or something, I'm going to liquidate that, wire it over, and we're done, right? Because we talked about last week about receivables, where you get, net receivables, 80 cents on the dollar. So I don't want to do any funny conversion on 80 cents on the dollar here and 75 cents on the dollar here. The bank's going to take it for 50 cents. Because when they know you're distressed, you're never going to get a good deal, right? When they know you're desperate. So I don't like, plant and equipment. They didn't do crazy stuff with it. They didn't have to buy factories and build factories with it, which depletes cash or something. The main takeaway is they have a huge amount of current assets relative to the overall assets. I like that. Okay, sight unseen, I don't know this company, but I like that. Continued. So we talked about the current assets and look at the current liabilities. I mean, right here, the current assets increased by 300. And do you know what? The amount of debt reduced by 80. Generally, if you increase debt and assets, it should go up together. So this is what I like in terms of your deleveraging, and you still got more money coming in. Second of all, if I need to run to Canada, I can take my cash, pay down all my debtors, and just kind of run on fumes and stuff like that. This is what Steve Jobs did, right? You repair your balance sheet, and right here, I'm using it because, I want to use it and I get some operating leverage, but my whole business is not predicated on that. So that's why I said, hey, when you looked at it, I'm not sure what kind of crazy ass spreadsheet he did, but I just need to look at this, the trend within the last 2 years where the assets are going up. And do you know what? When I say assets, it's current assets. It's not goodwill. It's not intangible assets. It's hardcore current assets. And do you know what? They're paying down the debt. I don't want you to pay down debt, right? I mean, I want you to pay down debt. And that's removing all operational risk if we get into depression, right? So that alone says, hey, that's really intriguing. So I just look at it as, from here, this is the qualitative stuff where I look at the balance sheet, I look at the income statement. Down here, I can see if they sold a lot of stock to get that cash, because I want you to generate the cash through the business, not selling more shares and diluting me out and stuff like that. So there's a lot more analysis in there, but at a high level, if you just need a 10, 15-minute look at it, you can never go out of business if you don't have a lot of debt. That's what my grandparents told me, Getting cheap multiples on this, and I don't use a lot of debt, and I get 15% net operating margin. Is not the worst thing that can happen. And what happens is when you have no debt, you become what we say a catalyst, right? We get bought out. Somebody plugs you in because they're buying really good assets at 50% rate, So so that's it. I mean, there's a qualitative aspect where I could go in and read all the annual reports and see what he said, and did he hit earnings, did he miss earnings, and how did he operate. This is my 15-minute view on this to give you guys what you wanted without really drilling down. If this stock was not bought out, I maybe would commit a little bit more time, but the valuations is high, right? This is like a Facebook. It's at a trading at P of 20. You know, if it's trading at P of 10, I'll be interested. 20 for something that's netting me out 50%. It's interesting, but I got better ideas. So my better idea, I'm going to try to close this out in 10 minutes. It's Deutsche Bank.
There's no hurry, Bill.
Okay, I went.
No.
Okay, this is the L shape. This is my largest holding. Okay, so this is our largest holding. We've been liking it, and we liked it at 17, and we still like it at 14 and stuff like that. Okay, so we eat our own cooking, and you know, I like to say right or wrong, I'm on record on a webcast here of saying it. Okay, so things about Deutsche Bank and stuff like that. If everybody knows, the main time was 2007, 2008. It was when the housing bubble kind of blew up. If you look at what was that movie by Michael Lewis? That
Big Short.
The Big Short. I mean, Deutsche Bank was the person on the other end of the table taking all this crap and stuff like that. If you look at the CEOs that were running it, and all the CEOs during that time, they were 100% marketers and stuff like that. They were pumping up the big dream, and you gotta do this because it's going to run away from you. So different market cycles generate different types of CEOs. The CEOs that we have right now is just operators. You just need to grind it out, and you just gotta, do the right thing. So down around here, this thing, and you can say, hey, there's the V, and that's the dead cat bounce. It's not sustained. Large companies do not fix themselves that quickly. I've been fixing a lot of companies, looking at a lot of investments. This generally doesn't happen, right? This generally doesn't happen. It does happen sometimes, but generally it doesn't happen where it suddenly just recovers and stuff like that. It kind of trends off. If you can get this dead cat bounce from a options perspective, then that's great. But I look at the fundamentals were not fixed here. The crap, that toxic assets that were on its balance sheet was not fixed. The ramifications of mark-to-market was not fixed. The CDO/CMBS market in terms of counterparties willing to pay for it was not fixed then. This was just hope and dreams here. So I look at it as, I didn't touch it. I touched it right here. They got a new CEO here. So what I want to say with this is, the PE, if I normalize those one-offs, is around 10 right now, okay? So it's in my ballpark. It's trading below tangible book, and we'll go into this, but this is the L shape I'm looking for. If I'm right, it's going to turn into a U. So all this, and some of the stuff that we did with other industries, the banking industry is very unique. It kind of has different metrics and different ratios that you need to be cognizant of. And this idea started with the Davis family book, where I read it. It's not the greatest book out there, but they built their fortune on financials. They have Davis Financial, and that's what they're famous for. They have multi-generational guys that ran the hedge fund, the mutual fund. It's much like Templeton with his international markets. They are what Templeton is to international as they are to financial. Yeah, I mean, they're not bad. I think they lost their way a little bit, but do you know what? Banks are legalized monopolies. They really are. And they're better than utilities. They have components of it, and they have high rates of return because of leverage. But if you're going to get leverage from anybody, getting it from the Fed, who are political, who don't want to really kill you, it's not bad, actually. So I can get into that forever, but I'm not going to go there. But why I got interested in this, because I saw the headline risk with Bank of America, the big fat L, and we pounded down on this at 8. Right here, we looked like idiots buying it up to like 10, and then it came back down to 8 again, and stuff like that. And now it's at 30. It's a major holding. We like Brian Moynihan for what he's doing. He's doing what needs to happen. So this is the exact same playbook. People say, hey, history doesn't repeat itself, but it does certainly rhyme.
Well, where did you buy it on that chart?
So I bought it multiple times. Right, I bought it around here, 810. So my thing is, I don't buy it once. I build my position throughout because that's what I need to do. And with each earning quarter, each release, I'm measuring the operator to see if they're doing what they're saying they're doing. Once they lose faith, I will sell the whole position. But I just look at it as he was settling with the DOJ. He was divesting his crappy businesses. He was reducing his branch network and firing people, which is not an easy thing to do. Those are things that he had to do. So that's the playbook that you had to deal with. You had to borrow money from the Fed that reduced all the interest rate all the way to a really low rate so it could give you time to rebuild your balance sheet. So I know there's something in the industry called seasoning where the window of maturity where you're getting your debt off kind of goes, right? You just need to let that window of crappy loans get off your books and the new good ones come on. So we're waiting for them to get their book repaired. And after repairing the books, you need to give it a couple quarters for it to reduce the loss ratio and stuff like that. So we get that. We get that it's going to take some time to replace the crappy stuff with the good stuff and let the good stuff kind of overwrite the bad stuff. So we bought it here, and there was bounces here. I know this looks like a blip, but it went up and it came down and it bottomed and everybody hated it again and there was headline risk and it's $14 billion in a DOJ settlement and stuff like that. But some of that was in cash. Half of it was cash and all of these consumer protection program kind of funny money programs and stuff like that. So we did that. We said, hey, do you know what? Legalized monopoly, we could scale out big into it. We like the owner-operator. We like the balance sheet, at least the trajectory it was going at. Same thing with Citigroup. You lose the text, but what I want to show is the L. If you bought it here, you're hating life. If you bought it here, you're loving life, right? It's all context. So if you look at this, the chart looks different, but Citigroup was like 6 months to a year behind in terms of their repairing of their business. They had a lot of toxic stuff. They had a CEO that was a little bit marketeer. I mean, I like Brian Moynihan better, but Michael Corbett is not bad and stuff like that. And both of them, stick their foot in their mouth by trying to be too aggressive with the Fed and ask for dividends too early and stuff like that. And it took them a year for them to repeat the stress test and kowtow to the Fed and stuff like that. Even stuff like that, they just need to know their role because I think part of the time.
Right. Well, I didn't mean to interrupt you, but why is Deutsche Bank taking so much longer than all these other huge banks to recover? It doesn't seem to be recovering.
They're not, but you know what? They turned a bend, and we'll talk about that really quickly.
I agree.
So number one is you got to do the same things, right? This is the L, but if I was running a bank and what I see a bank is, you got to reduce risk. All that prop trading and all that betting on your customers and your internal and betting against Goldman Sachs on the other end, you got to get out of that because you could make a lot of money, but you could lose a lot of money and stuff like that. So all that internal prop trading, the bond trading with low interest rates and stuff like that, you got to be cautious with that. I'm not saying it has to go away, but you got to put some risk behind it, right? Don't shoot for the moon and stuff like that. Number two, get boring. The commercial business where, you guys are depositing your money and you're getting a 0.5 interest rate and we're lending it out 4%. It's really boring, but essentially what you're trying to do is cheap capital and lending it out at a higher rate. You're not getting 10% spread on it, but you're getting cheap deposit capital, cheaper than Fed funds rate, and you're lending it out at a higher rate. I mean, it's a boring business, but that's what a bank's supposed to do. That's what regional banks do. That's what your local banks do.
Is Deutsche Bank, is it under investigation, this Manafort case and things like that for money laundering? I mean, it's in the news.
It's in the news, but do you know what? They pay like $100 million, and that's shot in the dark. They have a stress test, so there's a lot of scrutiny. So the reason why I like companies with scrutiny, whether it's from activist investors or in this case the government with the Fed stress tests under the Obama administration, also it's kind of lessening with the Trump administration, is nobody can do anything crappy. You're under so much spotlight. You're not giving liar loans. You're not doing it because people's jobs are at stake. The CEO is not going to let you go crazy to eke out another like 50 cents and stuff like that. So I love scrutiny on highly regulated businesses because that's where, this crazy whatever stuff gets shown. All the cockroaches kind of go away. Simplify the business, which means divesting the business. I don't know why you do these CMBS and these subprime things. I know they can make a lot of return, but you can lose a lot too, right? So they have high rates of return, CMBS and stuff like that. Let's just get back to 4 lines of businesses or 3 lines of businesses and like divest all this stuff that still makes a lot of money, but do you know what? When you do your stress ratio, you don't get benefits for that high risk. It actually is to your detriment. So the CEOs are incentivized to, not make it so risky. So this is like, make it simpler to understand by Wall Street and your shareholder base. Like, if I know what this box is, I can understand it, I can price it, and I can, invest in it. Reducing costs, reduce the staff. I know you don't want to hear that, but, reduce your footprint on the branches. Everybody's going mobile right now. Reduce it. DOJ, hey, do you know what? You got your hand stuck in the cookie jar, just pay off the thing. I mean, it's headline risk, but it's a one-time, one and done, right? So you need to acknowledge your misgivings from a prior CEO or whatever. Acknowledge it, just move forward with a clean slate. So I know this is always painful, but every bank from Wells Fargo to JP Morgan to Bank of America, Citigroup, they all have to do it. So again, reduce the cost, pay it up front, at least you don't have to pay it again, just keep plowing through it. And then increase capital. So the one good thing about these stress tests is there's a certain amount of capital that says, hey, when we model this, where the stock market goes down by 50% and the housing market goes down by 30%, that you can survive, right? They want to model it and it forces you to be rigid. So what they do to do that is this ratio downplays all these esoteric investments that nobody knows about. So what they're doing is divesting their core business, the subprime business, some of these crazy credit card businesses, the loan shark businesses. Get rid of that. If you're Bank of America, there's no reason why you have an African branch and stuff like that. I know you want a global branch, but just sell all that stuff to a local company and stuff like that. Simplify the business, and then also, if you're a bank, if you read the Davis thing, anytime you can buy a bank, mostly a regional bank, at below book value, and definitely below tangible book value, you have really good odds. That's what it comes down to. You read that book, you do research. If you can buy a good riskless bank at below tangible book value, underscore bold, from now to eternity, you got to buy it. Tangible book value is just cash. So if you sell off everything and boom, there's your cash, no goodwill, no nothing, that's what I want a bank to be doing in terms of close down all the branches, go and run off, and just give me back the money back. So they had the opportunity to buy it below book value, and it was a great deal at 8 when it was below tangible book value, which is cash on hand. So in terms of Deutsche Bank, it's too big to fail. I mean, we talked about Bank of America and stuff like that, but Deutsche Bank is the flagship bank over in Europe, definitely in Germany, which is the largest component to EU and stuff like that. They're too big to fail. At 1.6 trillion, they can't fail just from a political perspective, So I look at it as in context. Number 2, Deutsche Bank, this number, because Donald Trump at the very last moment, reduced the tax rate, they had to reduce all that negative earnings that they had. So it was actually a one-off. They were supposed to make money, but hey, when you have to reduce all your write-off, that you can still write off, but it's not at 35%, but now at 21%, it reduces it. So that is a one-off thing that I can accept that says, hey, it was in a great bank, it just does it. I look at it as Deutsche Bank is number 20 in the biggest banks out there. This is 27. This is like 30 or something. And right here, the sales, Deutsche Bank has bigger sales than both of these companies, but they have twice the market cap. So if I can get down at the same market cap as these lesser companies that are making, some money, but not great money, this one's losing money, Credit Suisse. From a pair comparison, I don't think this is the dumbest thing you can do. We're talking about Bank of America, Citigroup, that's trading at 100 and 30, 40 billion, and this is trading at 30 billion. I mean, the biggest bank in Germany / EU is trading at $30 billion. Think about that for a second. It's worth more than that. Okay, if you do the numbers on that, it is, and we can talk about that a little bit. The numbers that matter in terms of the bank, the cap, the common equity ratio is how much equity that you have in store to kind of withstand loans. Number one, I think this is to the point where, hey, you're holding too much capital, and that's what all the U.S. bank says. We're holding too much capital. We don't need that because all the good loans don't need to have these, crazy loss. They're really good loans that we're going to get really good returns on. So we're going to do it to keep you happy. Don't fight the Fed or their version of it. Number two is, this is in euros. It's $25 tangible book value, not book value, tangible book value. And it's currently trading at the 11 euro pricing. So it should be around $40, okay? If I'm right, we're buying at 14, 17, and it's gonna go up to, hopefully, if we get 27, we're happy, right? But we looked at the same analysis we did for Bank of America, Citigroup, with below tangible book value. They're reducing their branches and employees, not at fast rate as we want, but hey, it's Europe, right? I mean, they're somewhat socialistic, right? So what we're looking right here is, if you look at it, is nobody was, hitting their stress test numbers early on in Europe, but everybody needs to be around 13%. If you look at Basel, in terms of how much capital a bank really needs, they need to be at 13. Everybody's trying to keep the regulators happy in Europe and the confidence of the economy happy by going 14, and that's what they're doing. So from a credit perspective, Deutsche Bank is not going to blow up. One, they won't let it blow up, but in terms of the amount of capital that they're holding, it's not doing anything risky. Yes?
Quick two questions. One, the last few years of losses, how they have been able to restore it? Did they issue stocks?
They did, actually. So here's the thing. Last year, they raised about 9 billion worth of capital at, I think, 13 euro. So you're actually buying it below their IPO price. So what the CEO who has since left. So there is a change in CEO, right? John Crine was the CEO. I liked him. Actually, he had to fall on the sword because of various reasons, but I don't think he was a bad CEO. And I think the person that got it, Chris Swing, right now, he got a really good position to be in. I would love to be him right now because all the things have been fixed. So 9 billion in fresh capital that they didn't spend. They just went straight to the bottom line, okay? So they have 9 billion, so that cash hasn't gone anywhere. So right off the bat, for $29 million market cap, you got $9 billion worth of cash from a reload last year. Number two, they just IPO'd 25% of their asset management, their wealth management business. And they got $2 billion for that. That goes straight to the bottom line with estimating that the other 75% is at least worth $6 billion, right? So right off the bat, you got $9 billion in cash, and you got $8 billion in this wealth management team, right? That's $17 billion just for those pieces. We haven't talked about investment banking. We haven't talked about the commercial retail business, right? So.
Second question, what gives you confidence that they would likely to make money given that they have
They
lost
don't need
so
to be
much?
smart about it. Banking, you should.
Well,
So
you could argue the same thing a few years ago, and they still lost money year after year.
because they were betting on their investment brokerage business. Like right now, the new CEO comes from the retail branch. The easiest business that you guys can ever make from a regional bank is borrow at 0.5% from your customers and then lend it out at 4%. It's boring, but if you want to be State Street and all these regional banks, that's how you do it, the old-fashioned way and stuff.
Where's all their assets and liabilities are located? How much they are diversified other than Germany?
I think they're like 20% in Germany, and then they also have Italy and also Spain. Okay, so those are areas of concern. But so one of the things where you're like, that's headline risk, they're not doing crazy stuff there, right?
They're only in Germany 20%?
So their local market, they want to reconcentrate on their local market.
Only 20% of their book is in Germany.
Yeah. They want to be a global bank. Anytime Citigroup or anybody wants to be a global bank, that's where everything falls off because you need to understand the different markets. So this is the last chart, I guess. So this is the playbook for how to fix a bank, Citigroup, Bank of America, and stuff like that. Reduce your prop trading. Right now, that's what the CEO is figuring out. What is the proper blend? I think he said the right thing in terms of we're evaluating every business, whether it's profitable or not. Increase the commercial side. They're going to integrate post-bank in there, and they're going to streamline the cost, which means firing people and reinvesting in technologies and stuff like that. That's not great, but it's great for shareholders. Okay? Administer stress tests. They're way above their stress test levels and stuff like that. And you know what? We'll know in like 2 months. Okay? simplify the business. They divested all their African businesses and all these little small rinky-dink things. Take the capital. They might not have gotten 100% on the dollar, but they're taking whatever they got and just saying, hey, let's invest in the core. Reducing costs, they're not, I put negative here because they're not going as quickly as I'd like, but again, it's still a viable business. They would have made money last year. It wouldn't be a negative except for the last minute, tax restructuring. In about 7 days or so, they're going to reduce earnings. But they did settle with DOJ. They know what they're going to pay. It's in the past, right? So it doesn't affect them in the future. There's no uncertainty. Lastly, divesting businesses, and they haven't gotten the authorization to buy back their stocks in bulk. But this year, they're expected to earn $1.63, and they're trading at like 11 right now. So I mean, you're buying it below 10% and stuff like that, below tangible book value. There's dumber things you can do. So this is our biggest holding. We like it because I think we like the CEO. We like where it's going, and it kind of fits what we do well, investing in financials and also distressed companies. Awesome, thank you.
There's nobody out there.